Hey everyone, welcome to the Bond Bank's mid-year Muni update. We've got just a few more folks trickling in here, and then we'll kick things off. Really appreciate you all taking the time to join us here. And okay, so like I said, thanks again. The Bond Bank does this biannually, once sort of after the new year, and then again in the summer. We typically arrange these market updates around our bond sales. And with that in mind, I know a lot of you came to us through our investor listserv where we gave out notice of this event. And I just wanted to quickly reiterate our timeline for our upcoming bond sale. Number one, we will be doing what's called a competitive bond sale tomorrow. That's where, for those that are used to buying our bonds that are individual investors, it's just a different type of bond sale where the investment banks, the financial firms will bid on the bonds, the lowest yield wins, and then they will distribute through their syndicate of other broker dealers and financial firms that may reach you or may not. But there should be more bond bank bonds floating around in the market after tomorrow. And then in a few weeks' time, and we gave notice of this in our preliminary official statement, which is the offering document for our competitive sale, we will also be doing a refunding bond transaction in late August. And that will follow a more conventional process where we work with a few financial firms. We give ample time for individual investors to be aware of the deal, to research it, to review our preliminary official statement, again, the offering document. We will give notice of that about 2 weeks before the sale, that the offering document is out there via our listserv that you receive notification of today's event. And we will be working with the financial firms that are shown on the screen here. And new to this group is TD Securities, who has a distribution agreement with Charles Schwab. So trying to provide a number of outlets for Vermonters to access our bonds. And on that note, Vermonters will be given priority in terms of orders for allocations of bonds with a zip code alongside your order. So to receive more information, if you haven't already, sign up for our investor listserv at vtbondbank.org/investors. And then also check back on the website. Also on the website, if you're new to buying Vermont bonds, is some educational materials on how the process works, what the rates might look like, and etc. But if you have further questions, always feel free to give me a call. My contact information is on that website as well. So with that overview, I'm going to turn it to our distinguished guest today. We have Tom Doe from MMA, which is one of the leading research firms in the municipal market. Really honored to have him here. He is a graduate of both Colgate and Harvard and has worked in the industry for a long time. Their weekly updates from MMA are read by sort of all the movers and shakers in the industry, and Tom's firm provides bespoke analysis for a number of buy-side firms as well. And in addition to all that, he was just in Cornwall this weekend visiting his sister, and his as he'll share, his niece is the coach at for UVM lacrosse. So great connection to the state. And with that, I'll turn it over to Tom. Thank you so much for joining us.
Great, thanks, Michael. Let me just pull up the deck here, and we'll get cracking. There we go. So, as Michael said, I have some connections to Vermont, which I'll share with you a little bit more in detail. But what I want to kind of take you through some things that are important to us in terms of aspects of the municipal market, and especially in light of tomorrow's bond sale, which I think is really well timed for the state. So I'll tell you a little bit about who we are, the opportunity that we're seeing in the market right now, the changing demand component that is influencing market behavior, the issuance patterns that we've seen to date and what we expect going forward, uh, the sensitivity that around climate that is not yet identified in the marketplace, either by pricing or by credit ratings agencies. And again, I'll give you a little bit of an update of the credit overview as we see it. One of the things that we focus on and have built over time is a large database on impairments and defaults. And so we can pretty much identify where there's risk and where there's not, and some of the trends. And then at the end, if there's some questions, I'll do my best to try to answer them. Just to give you a little bit of background about Municipal Market Analytics, I founded the firm almost 30 years ago now. I guess technically we're in our 30th year. We are an independent research and analysis firm. We are not associated with any firm that distributes bonds or invests in bonds. All we do is study the marketplace, and we make that information and our analysis available to institutions, and that can be issuers like Michael, or it can be large investors, the securities firms that underwrite bond deals. It can be municipal advisors. And we also are a resource to Congress, where I testified before Senate budget this past January, specifically on the issue about climate and risk to municipal bonds. Various administrative offices such as Treasury, regulators such as the SEC, and then we're a regular peer in the media as we try to help reporters that cover our market get it right. And a lot of them are new to it. And then, as Michael alluded to, my niece is the UVM women's lacrosse coach. So if anyone on the call has any budding superstars, keep UVM in mind. She grew up in Cornwall, Vermont, and was an outstanding, I think she's in Vermont's Athletic Hall of Fame. But my sister has taught in the Middlebury school system for 40 years. And we even have ties to Newbury, Vermont. So I feel very privileged to participate today with all of you. So just to give you an update of kind of where the market is and what has changed. And this is a graph. There are two lines on it. Well, there are three with kind of give you kind of a benchmark. But the gray represents the 10-year yield for municipals, which right now for a AAA GO would be somewhere around a 2.8%. And that nearly gets to a 5% taxable equivalent yield if you're in the highest tax bracket. And so that compares, of course, very favorably to the US Treasury 10-year, which is approximately around 4.14%. And what's interesting about this graph is I took the yields and I overlaid it with the yellow line, which represents the trading volume of what we call small block trades. These are the smaller trades that occur in the municipal market on a daily basis. And what happens is that individual investors are really are more savvy than the institutional players in our marketplace, because they tend to be really patient. And when yields rise above that 2.5% level, that's when they jump in and lock in attractive income, which often also helps their performance because they're buying, of course, a security at a low price. And since this financial crisis in 2008, 2010, there have been four specific times when this high yield has been attainable. Back in 2010, there was an analyst, Meredith Whitney, who incorrectly forecast hundreds of billions of defaults in the municipal market, which of course didn't manifest. But nonetheless, the fear around that spiked yields up around 3.5%. So a very attractive level, and retail trades rose above 50,000. Everything was relatively quiet until former President Trump was first elected in the fourth quarter. And so in the fourth quarter of 2016, we saw yields spike again, and so did retail trading activity. Then in the first quarter of 2020, COVID hit, and again, yields spiked very high, as in retail trading also jumped in, and individuals recognized the value and locked those attractive levels into their portfolios. And then finally, we've had this extended period of the Fed's involvement for the last 2 years that has enabled individual investors to re-engage in the market in a way that they haven't done for a sustained period of time for several decades. And so this is where there's been a real change in the demand in the municipal market from what have predominantly been most investors had used mutual funds to access the municipal market. And now what we're seeing is individuals are retaining a financial advisor, a wealth manager to help them structure their portfolio, or doing it themselves. To give you a little bit of an idea of what's happened with mutual funds, is that the red line here, well, excuse me, the yellow and light blue and the purple lines represent the period of time from 2019 to 2021, where we had inflows into the large municipal bond fund complexes. That would be the Fidelities, the Nuveen's, the BlackRocks, Vanguard. And then in 2022, when yields started to rise, they saw those funds saw an exodus of investors and a record departure from the funds group. And then in 2023, last year, they still hardly any movement, but still some outflows in the latter part of the year. And then this year, it's been relatively stable. And what we've noticed is that investors have moved. Individuals who are in the funds have exited short-term funds and instead invested in long and high yield funds, have not invested in intermediate maturities, but rather they've bought bonds directly in that intermediate range. And when I say intermediate range, between 5 and 12 years maturity levels is what I'm referring to. So it's been a pretty interesting shift, and what the result has been is that it's been there's been a slower distribution of new issues. So, for example, larger issuers such as state of California or Texas or New York, Illinois, who do issues that are in the billions of dollars, will have take a little bit longer to distribute bonds. They might have to price the bonds a little bit cheaper, meaning with a higher yield, in order to attract interest. Vermont derives a benefit from not having bonds come to market very often. So usually there's pretty good demand and lower yields than what we experience in other comparable rated securities. So issuance, it's been interesting this year, is that a lot of state and local governments decided to be, one is that they weren't sure, they thought Fed policy was going to, they initially thought it was going to move to lower yields. And so there was a lot of demand early on, and issuers seemed to try to feed that demand. But then expectations of the Fed cutting rates ended up not occurring. And so then there was a rush of issuers to come to market to take advantage of the kind of a stable rate environment before rates might have gone, maybe been adjusted higher. And then the political situation and the uncertainty around the presidential election also encouraged state and local governments to come to market, while there was a lot of interest by individuals to buy bonds at these relatively attractive levels for investors. But still, if we looked at yields back 100 years, the current levels would be pretty low for financing important infrastructure projects in a state or a city. What we're expecting, so through the first 6 months of this year, we've had the highest or the fastest rate of issuance that we've seen in history. There is over, I think actually through July, there's going to be almost 280 billion that will be issued. On average, the last 10 years, there's been about 400 billion issued each year. So we're actually on a pretty amazing pace that maybe will increase to 500 billion, though we do expect that overall issuance to decline when we get around the election in November and December. We're thinking that issuers will probably get most of all their kind of work or financing done before that election date. Longer term, we're expecting that municipal issuance will actually increase substantially to perhaps as much as 800 billion a year, and largely because of the need of state and local governments to finance climate adaptation projects. So this would mean projects that would help to deal with the consequences of extreme weather. And as you all have experienced in Vermont, the flooding, the heat in Arizona and Texas, the concerns around sea level rise, all these issues we think are going to generate tremendous financing needs by state and local governments. And the federal government really doesn't look to infrastructure for the consequences of climate. They tend to focus more on carbon capture and electric vehicles and that type of thing, which is called mitigation projects. So just to kind of talk a little bit about climate, because we do believe that it is the biggest challenge to the municipal industry going forward. Currently, the market doesn't recognize climate risk, and so we're advising issuers who are experiencing severe weather conditions that they should try to issue bonds now before the market penalizes them. So they're actually getting free access, even though they have a tremendous risk. In July, we issues in Harris County, Texas, and Houston, Texas, which were underwater from the Hurricane Beryl. Phoenix, Arizona, that's of course experiences extreme heat. New Orleans, which may be uninhabitable in 20 years, was able to issue bonds today, as a matter of fact, with very little any type of penalty, yield penalty. Issuers are not really disclosing climate risk. It's very inconsistent, even though that they've been given guidance by their trade association on how to do it. And so this becomes a little bit of a concern from an analytical point of view or from an investor point of view, is that it's hard to get information about just what kind of climate risks exist for any type of bonds you might purchase. Fortunately, there are companies such as First Street Foundation that provide such information for free, I believe still free, although I know they're going to a commercial model. But so you can look at your area and get an analysis of what type of or the area for not just where you live, but for the bond that you're considering, and identify whether there is some long-term risk there around the variety of extreme weather events that might hit that area. We do think that one of the interesting things for municipal industry going forward that we think will be a credit concern, which will be the migration of tax bases. We experienced this during COVID. So we know that people can be fluid with jobs and work for the most part. And this is, we think, will pose some risks as some places are uninhabitable. And then how do you stabilize those areas when your tax base leaves and your workforce departs? And then the other side of that is preparation in areas where we have an influx of population. Already we're seeing in the Southeast, in the Carolinas and in Georgia, for example, is that there is a planning and assessments right now of how to provide enough electricity for not only the influx of people, namely from Florida, who are migrating north, but also for manufacturing and technology businesses that have great energy consumption demands. So we think that's these are going to be really challenging elements for the municipal market. One thing about Vermont, there's a book I read recently called On the Move, which is about U.S. migration and as a result to climate. And the two areas that are best for climate, despite the floods in the Northeast Kingdom, are Vermont and the Upper Peninsula of Michigan. And so just Vermont is not alone. This FEMA is that flooding is everywhere throughout the U.S. It's one of the kind of the quiet risks that people don't seem to want to talk a lot about. And as we all know from having experienced this type of catastrophe, how significant it can be, costly and displacing people and disrupting people's lives. So we hope as a firm that this will continue to be derive more attention from our representatives in DC, and that there will be just greater prioritization of dealing with climate, the consequences of climate by state and local governments, because quite frankly, FEMA does not have the ability to cover all the losses that are expected in the years ahead. Just to give you an idea, this is and I know we're talking about municipals and not to spend too much time on it, but this is a map from 1915 to 1970 of the migration patterns of the Afro-Americans who moved from the Southeast up to the jobs in the Midwest, Northeast, and West. And I just pose this as, I think this is going to be, we'll see similar type of graphs like this in the years ahead as people move away from climate at risk areas into areas that have less risk. So coming back to, instead of the concerns about credit, let's talk a little bit about how safe the municipal market is here in the near term. And so when we look at the number of issues that have experienced some type of credit impairment or have defaulted, it's pretty much been in the non-rated area. If your bond has a rating, then your risk of default or impairment is fairly low. In fact, since 2009, only 185 issues have encountered some type of impairment. And that doesn't mean that they've defaulted and left the investor without any money. It just means that they've encountered a problem and they had to resolve it. And many of them do resolve those issues. And again, there were approximately 36,000 different municipal bond issuers. So you can do the easy math of very few of the rated securities have experience any type of adversity. So when we look at safe credit sectors, and this is a listing of them. So even though water and sewer and local non-GOs or local GOs do experience some adversity and have over the last 15, 16 years, it's still relatively small. But these are the areas that when we're talking to investors and looking for a concentration of safety, this is where investors tend to look and focus. In contrast, these are the risky sectors of the municipal market. And the ones that have had the greatest adversity are land secured deals, which are rarely in Vermont, mostly in Florida, retirement facilities, charter schools, and then small, usually multifamily housing facilities that are funded by municipal bonds. We have had some concerns recently or this year about hospital financings, a lot of that because of cybersecurity or risks, but also just in terms of insurance reimbursement. and the challenges that those institutions have been facing. And of course, climate's going to impact them as well, as they all need to upgrade their HVAC systems, especially those that are experiencing in areas of extreme heat. So again, just a long-term view of municipals as investment, and this is looking at the total rate of return. So that means the income you receive from the bond, as well as the principal appreciation that you would have on your securities. And we're able to look back to 1965. So nearly well, I guess almost 60 years of returns, and only 3 times since 1965 has a municipal 10-year bond lost more than 5%. And if you look at those red columns, which were the negative returns, of which 8 years had a negative return, the next year was often strongly positive. And so this is again, as I was saying, when we see those spike in yields, when we started that first graph we looked at, that's when individual investors have been particularly savvy to pursue the income opportunity that yield adversity can provide to the marketplace, and creates an investment opportunity that comes rarely. And again, we're in a period of time that's still attractive yields for investors, and we expect that to continue until the Fed really starts reducing rates, which we're all expecting in the next hour and a half to learn a little bit more about that. But probably those rate cuts don't happen until September. This year, the pursuit of higher yield and income has drawn individual investors to high yield. And so this is the columns by maturity range along the yield curve, and the total rate of return for high yield, which are the gray columns, and then investment grade, which are the maroon columns. And you can see for the most part that if you're in investment grade securities, is that it's really been a relatively flat year. It really hasn't been, you've derived income, but the principal value of your securities has had some volatility to it, so that you may have, say, a net loss on your principal. But of course, if you're buying a bond by maturity, you'll be made whole at maturity, so you don't really have to worry about that volatility. Whereas high yield has performed exceptionally well. And what we believe has been occurring is that because of the low default risk of all municipals, again, a little bit higher in those risky sectors than investment grade, but because of the overall low default rate, is that investors were seeking to get the returns that were most optimal in October of 2023. When we had that really high yield spike, individual investors were extraordinarily active at historic levels, taking advantage of the high yields and income opportunities. So for their managers, the institutions managing individual money, well, they had to try to provide that same high level of return to meet the investor expectations. And so they started dipping into high yield. And so these separate managed accounts, wealth managers, have moved out the maturity curve and down the rating scale in order to capture an attractive level that will retain individual investors when they're comparing their investments to the rallying equity markets. And so this has been a dynamic. In the last, this past July, this graph encompasses year to date, so through July, but in the month of July, the high yield returns had tempered somewhat, and so are not outpacing investment grade. So we actually think now is a time that investors should be looking at the investment grade sector and be very wary of high yield, because we think it's just become overpriced. So that's good news for Vermont as having a strong credit rating. So just to tell you a little bit, as I mentioned, my niece, who's the coach at UVM, well, her brother, my nephew, is a scout for the Philadelphia Phillies in baseball. And he always tells me at the start of every year that a Major League Baseball team, regardless of the quality of players they put out on the field, is that they'll win 60 games. And the success of any baseball team in the major league level is to win 30 of the next 102 games, and then they'll have a successful season and apt to make the playoffs. Well, in the municipal market, this is a distribution of the daily price change of municipal bonds. And so when we look at it in terms of daily percentage change, is that from an plus or minus change of 1/8%, so pretty small. That's really an unchanged market, and that's the middle columns you see, and the maroon represents the annual distribution. So 158 of 250 trading days, the market is essentially unchanged. And then as we move out to the right and left of that center, is we see the plus and minus of incrementally larger price change. And on the far ends, a change of 1/4% on any given day is very unusual and very large, but represents about 46 trading days in the calendar year. And it's those days that, as an institutional investor now, so not somebody who owns a bond and is going to hold it to maturity, but for a portfolio manager who's trying to trade the market, outperform an index, provide a total rate of return that's above average, is that their ability to either participate in the 23 days where the market is extraordinarily positive, or to avoid and to manage their risk on those 23 days where it's negative. That's their whole year, is all about 50 days. So the municipal market really is very similar to Major League Baseball when you really come down to it. The last graph that I want to, second to last graph I want to share with you is a phenomenon that's occurred since August 2022. And what these columns represent is the performance of the first half of the month in maroon versus the first half of let me back up. So is the first half of the month is in maroon is since August 2022, almost 12% gains in the first 2 weeks of every month since and including August 2022. So essentially, if you are an investor and you bought bonds at the first part at the start of the month, so if you buy your Vermont bonds tomorrow on August 1, is it your probabilities is that you will have an outperformance versus if you were to buy those same bonds in the second half of the month, which since August 2022 is almost a loss of about 17%. Interestingly, before August 2022, it was just the opposite. Prices declined and underperformed in the first 2 weeks of the month and rallied in the latter part of the month. And the last columns is the yellow, is that July followed that pattern of outperformance in the first 2 weeks of the month and underperformance in the latter 2 weeks. And what this represents is that municipal investors who are now individuals are buying bonds, not institutions, but individuals who are now active in the market, is that they have coupons that come due at the start of each month. And so they get income. And if they're not using it for their own spending and for their own their daily means, is that they will reinvest it and buy more bonds. And so that reinvestment activity has had a disproportionate impact on the municipal price performance in the first 2 weeks of a month. So again, Vermont, being an issuer in tomorrow, is that they're taking advantage of a bias toward a stronger marketplace. And because there was so little weakness in the second half of July, is that Vermont will benefit from that positive activity earlier in July. So really good timing by Municipal Bond Bank to coming in the market Again, none of these things are certain because things change all the time. But if you're playing probabilities, then that's really most advantageous. And then finally, before if there are any questions, is that again, with any bond investment, the greatest risk that really exists is inflation. And yeah, I wanted to just remind you all of back of 1962 to 1974, which was a period when inflation and stagflation occurred in the municipal market. And this is a graph comparing long municipal yields, the maroon line, versus the performance of the Dow Jones, the gray line. And you can see that equities started down at a Dow Jones of 600. You're thinking that it's around 40,000, above 40,000 today. And it had a lot of volatility, ending up back at 600 by the mid 1970s. Long yields rose in the 1960s up to 1970, then declined before increasing again in the latter part of the 70s and taking us into that spike in 1980. And that was a period of time, of course, that some of us that are old enough remember as being record inflation in the US. But inflation erodes the value of a bond. So that if you buy a bond and we have inflation, well, what that means is that you're just going to have a valuation that will be lower. You'll get your principal back at maturity. And of course, you can reinvest that coupon income in at higher yields. And so there's an opportunity there. And I think it's really this long-term inflation risk and the concerns that regardless of who wins the presidential election, that the US deficit kind of provides that long-term issue that investors have to try to deal with and understand. And that's something that just want to keep in your back of your mind and be aware of what the Federal Reserve is doing and the headlines around that. And so with that, I'll conclude my remarks. And if there are questions, I'm glad to take them. And we can go from there.
Let's see here. So if anyone has questions, you can either use the raise hand function or why am I Zoom was doing us a favor by keeping me off camera. You can use the Q&A or the raise hand function. Maybe just to kick things off, Tom, didn't quite prep you, so putting you on the spot. But you talked a lot, and we certainly have people on the call here that participate in the municipal market through SMAs, and that's been obviously like just a fundamental change in the way the market works, and I think is, as you discussed, influencing the sort of monthly returns. And I'm wondering, MMA, or in your perspective on risk associated with SMAs. One thing that comes to mind is I think they are sort of marketed as this ability to have institutional-like management, but some bespoke abilities in terms of selecting the securities you'd like to fill the bucket. But if you listen to the market, a lot of the technologies that are being used to grow the SMA market sort of have a bias towards homogenization. And so I'm just wondering, if you have a perspective on that and risk that might be out there, despite there's sort of a disconnect between it being customized and then sort of like homogenous technological solutions to facilitate this market.
Well, I mean, you always have to keep in mind that anyone who's managing your money is running a business. And so they're charging the investor a certain amount of money to manage their money, and they're trying to do that as efficiently as possible. And technology has been instituted to help that out. And to your point about the homogeneity of portfolios, is that because 90% of the municipal market is investment grade, and because most investors aren't looking for performance, they're just looking for income, is that portfolios tend to be rather placid, or rather passive. As I pointed out, is that a lot of these SMA accounts have entered into high yield because they're trying to generate returns to retain investors and taking on that risk that I'm not always so sure that investors are aware of that their portfolios change. The concern we have regarding climate long-term is that an SMA account or someone who has a portfolio, if it's not large enough, they may not have enough diversity in their holdings that might make them susceptible to a adverse event that a mutual fund would give them that protection. So there has to be a little bit of I think, careful thought process as to why you're investing, as always. Is it for performance or is it for income? I think the municipal market is a great income place. I think you should be buying NVIDIA stock if you're if you're thinking of buying performance, I guess. And so I think that's really what's happened. That's kind of the long and short of it is that it's just a question of do you have enough assets to give you the diversity of holdings that gives you comfort and concerns. I also believe too is that if your manager can't answer the climate question regarding risk on your investment, then you should really think about talking to someone else. I think I do believe it's the number one issue that's facing the municipal market, and to the degree that it's disregarded is unconscionable. And I think and it's so easy to get answers and get them provided. I've asked several large institutions about whether they're profiling their portfolios for climate risk, and they are silent and doing nothing. So that is a big concern to me in the marketplace, and the rating agencies too are relatively, even though they're selling analytical services in terms of the ratings, they're not incorporating climate into those ratings, really, in any consequential degree.
Thank you. Question from the audience here. Do you believe better issuer disclosure of climate risk translates to more market recognition of these risks? So sort of differentiating yourself, I suppose. And then many disclosures seem to be black box disclosures, similar to what you see in the medical community. So any thoughts on that?
So again, I mean, we've done studies that we've provided to the SEC about climate disclosure in places like Phoenix and Harris County, which is the Houston area, California. We've looked at the New Jersey coastline that got wiped out by Hurricane Sandy a number of years ago. And we looked at the climate disclosure, and it's been really disappointing. I know, Michael, you're involved with the GF, the Government Finance Officers Association, that provided a best practice template to the issuer community back in 2021 that largely is ignored, which to me is a travesty. But that's just the way it is. And as we know that even in the presidential election, people are more concerned about immigration and the economy than they are about climate risk. And so the investor community in municipals is really reflective of the general population, is that for all the headlines and all the concerns and all the stories that are read, is that still it's not translating into any meaningful rating action and any meaningful price penalty. So, and as a result, if the investors aren't asking for it, the issuers tend not to provide it. So, because they're being counseled by their attorneys that there's risk if they disclose that there is risk. Well, it seems kind of backwards a little bit to me, but that's the way the world works.
If the audience would like a great example of climate disclosure, our POS is out there, and I think has some really knowledgeable and helpful links to studies that have been done around the state.
Excellent.
The other big cohort of this audience, Tom, are local borrowers here in Vermont. And so you spoke a little bit about anticipated issuance, similar of a similar theme, oversubscription for FEMA, infrastructure, et cetera, and then just aging infrastructure more generally. And wondered if you had any comment on market absorption looking forward. Our market's basically been $4 trillion for the last 10 years. And so, just any thoughts there, and how tax policy change may or may not impact that demand.
Well, the right now, because of the high yields, again, which is the opportunity for everybody tomorrow who's buying, who may be interested in investing in your deal, is that and again, that first chart I showed is that when we have a 10-year yield that's above 250, which means more than 4% on a taxable equivalent basis, that's attractive to an income-oriented investor. And so that enables an issuer to tap into that demand. Of course, they're also incurring higher costs. But as I also said, over 100 years, this is still a period of low borrowing. I mean, it's not what it was when the Fed rates were at zero, right? But that was an unrealistic expectation that would go forward. So here we're still below historical rates. From a borrower standpoint, we have attractive rates from an investor. I think the concern is that, or the challenge will be, is that should yields, well, if the Fed goes starts reducing rates and we start seeing yields decline below that 250 level for a 10-year maturity, and that's a tax-exempt 250 yield, is that whether SMA interest will then start to dry up. And they'll start looking to taxables or looking to the dividend stocks or that type of thing, and they'll diversify that way. So that's what we just don't know. I do believe that the mutual funds will come back for some of the reasons I mentioned around climate. I think as yields, if the Fed starts cutting rates, then there'll be a performance element that they'll be able to market, and they'll show these positive returns, and that will start to draw investors from SMAs into the portfolios. And mutual funds in the municipal market started in the 1970s after New York City had its great financial adversity. And that caused a lot of investors' concern, and the mutual funds were started. Of course, there were extraordinarily high yields too, and the expectation those high interest rates and inflation would come down, and that enabled, again, to sell a performance-oriented product. So I think issuance is going to remain pretty steady. As I said, I think it'll probably decline sharply in November and December because of the election concerns. Next year, I think we'll probably see similar kind of high levels because the borrowing costs will be lower, and that will also allow some state and local governments to refund their bonds next year, refinance to lower yields, and so I think that will continue to maintain high levels of issuance, and I think the demand will remain there because I think as again, the baby boomers are old enough now and starting to reallocate in their portfolios. They've had a pretty good run. Even those people that have been very aggressive with an 80% allocation toward equities are probably going to come to more back to that traditional 60-40 relationship or 50-50, and the fixed income demand will be in the form of seeking municipal bonds. And you asked the one question again, next year, the tax law changes. I don't have, my crystal ball's not that good. I think the good news is that while there are some concerns that the tax exemption could be vulnerable in any type of tax reform, I don't believe that's true. I think it's here to stay. And certainly the feedback I received from questioning from the senators in January, when I was before Senate budget, is that they recognize that the importance financing tool that municipal bonds provide for low-cost financing, not only for new projects, but also refurbishing existing infrastructure, and of course, for the adaptation projects around climate. And as we also know, Michael, is that with severe climate events, is that that's also stressing aging infrastructure, so that infrastructure that's vulnerable sometimes the problems can be exacerbated by extreme weather. So those are going to be the things that are going to continue to drive infrastructure investment and demand for municipal bonds.
Well, thank you. Amazing perspective. And I think with that, we'll probably wrap up here. I think what I appreciated most about this, Tom, is the respect for the individual investor. And that's something that we are very focused on here at the Bond Bank, as we feel like we offer quality, two public goods. One is the investments we facilitate, and two is the investments that people can purchase and own part of their community. And we have a lot of respect for individual investors as well. So with that in mind, folks, if you could just keep an eye on our website for more information about our upcoming deal. This presentation we will put up on our website if you'd like to replay it or send it to others. I think great perspective on some of the climate questions and the trends impacting the business. And with that, just a huge thank you from Vermont to Tom, and we'll talk to everyone soon. So thanks again for joining us today.
You're most welcome.
Take care. Bye-bye.
Bye.